Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Cyril O, Miko L, and Andy S. Sylvain Baude is on the show today. Sylvain is Chief Investment Officer of Eightstone-Oclaner, a Singapore-based wealth management firm focused on fixed income and multi-asset strategies. You can learn more about the firm on their website, eightstone-oclaner.com. Sylvain, thanks for coming on and welcome to the show.
Thank you, Andrew, for having me on. Real pleasure to finally speak with you.
Absolutely. Likewise. How's things going in Singapore these days?
Well, I guess things are a bit tough given the macro environment and the split between China and the US, but I guess still pretty good compared to other places.
Can you speak to that for a moment? You know, we've got some of the issues in Hong Kong going on. How do you feel with Singapore? And are you of the opinion that Singapore is probably, at least in the top two jurisdictions in the world now, for a good wealth capital base and a safe, good jurisdiction for capital and good regulation? What's your thoughts on Singapore at this point?
Sure. Well, I can tell you that, we came here 9 years ago to set up the company. When we came to Asia, we were actively looking into Hong Kong as well and Singapore. And back then, we really decided to go for Singapore because we thought that Hong Kong was going back to China one way or another. And we wanted to be like in a place like Switzerland where it's really independent and there's not much outside influence on the place. So we think Singapore is the big winner here from what's happening in Hong Kong. We've seen massive outflow from Hong Kong to Singapore, and I think also the Singaporean government have communicated quite well on the issue, and they are very cognizant to the fact that they have to really take into account people's opinion and not try to enforce too much on the people, and really take into account what's happening and how people are evolving nowadays.
Very well. I appreciate you sharing your thoughts on it, given that you're there on the ground. Well, Sylvain, can you give us an overview of the fund, your experience and background, why you come to focus with this fund on fixed income and multi-asset strategies?
I've been in the asset management industry for about 20 years, starting my career in Paris at BNP Paribas, managing portfolio for high net worth clients. Then I moved to Monaco with BNP, and then was back in 2007. And then I decided to go more on the independent route, and I joined a Geneva-based independent asset manager. I spent 2 years in Geneva, and then one of the partners asked me if I was open to open a company with him in Asia and Singapore, and so I ended up in Singapore 9 years ago, and I've been acting as the CIO of and executive director of the company. So we recently merged with another asset manager called Eightstone. That's why the name is now Eightstone-Oclaner. And happy to say that we are running a $1.5 billion in assets. And mostly what we do is fixed income for probably nearly half of the book. Fixed income strategy, so we're really active, really looking at Asia, US dollar bonds, and on the other side, we do a multi-asset strategy program, where it's more like a top-down macro asset allocation, where we try to generate steady return with a relatively low volatility. So in this multi-asset strategy program that we have, we look at thematics for investments, big trends, and we also have a pocket that we call a tactical opportunity, where we are ready to reanalyze a contrarian idea or an idea that can have an outstanding risk-reward ratio with a 1 to 2 year horizon. And in this pocket at the moment, we have a fund, if you will, a sub-fund focusing on uranium mines.
I want to ask you, before we talk more about uranium, can you speak to the performance of the fund, the key management folks at the fund, and then also, are you guys looking at potential clients, and what might those terms look like for potential clients?
For the fixed income program, we have a team running the show here. It's a former portfolio manager from a hedge fund called Mountain Capital. So he's spending his time on fixed income arbitrage and convertible bonds, where we think there's a lot of value to add. So for the fixed income, we are very happy this year. I mean, given the short maturity that we have in the book, we are up 10% mid-December. Last year we were down 1.5%, so we think we did a good job last year to protect capital for our investors. And on the fee, or we are very transparent. We just charge a management fee, which is between 0.7 to 1%, depending on the assets of under management. And for the multi-asset strategy, it's more a globally diversified portfolio, where we have various assets like equity bonds, we have some commodities, and we have some private equity as well. So for this strategy, it's been a very good year as well. I mean, this year is quite an easy year. Everything is up. So we up also in US dollar term about 10%, with the volatility of around 3.5%.
And for the potential clients, what size of client are you looking for? What's your minimum?
So within the business, we have two different line or channel, if you want. We have the wealth management, where the client comes in and sign a mandate, and we manage his account that is custody at the bank of his choice. So for this side of the business, the minimum requirement we have by regulation is about 2 million, but we're really looking at a bigger portfolio in about 5 million US or onwards. But we have another side of the business, which is the fund management business. So what we try to do in the fund management business is to replicate what we do for our biggest clients into a fund format. And for that, we have a UCITS Luxembourg-based platform where anybody can invest. Those funds are registered in Europe and in Singapore as well. So anybody can invest any amount of money they want into those funds.
Can you go into just a little bit more detail as far as, we'll get to uranium in a moment, but can you speak to what areas in fixed income are you looking at? Is there any potential ideas that to give us an example on that side? And then over on the multi-asset side, are there some other areas of the market that you're looking at? And can you maybe share with us some of the ideas that you're looking at there?
Sure. So fixed income, we've been doing that for the last 9 years. We really focus on Asia credits, or investment grade and high yield. So the idea behind the strategy is to have a portfolio construction process that is really robust to any kind of market scenario. And for that, what we want to do is to blend investment grade, so long end bond, with the short-term high yield credits. So for what we do by blending this, what happened by blending those two components of the market is that you reduce the volatility and you reduce the drawdown of the portfolio. So in a way, when you program the portfolio this way, you don't need to have so much of a hedge on top of the portfolio, and so you reduce the cost of hedging. Now, what we're looking at the moment is we're really looking to some I would say double B, single B bonds, where we had some spread widening for the last few months. We try to avoid some of the mainland Chinese issue in US dollar. I don't know if you saw, but the last few weeks you had a lot of default in China, even for top names like the Peking University that just defaulted on their bonds. So we try to avoid what we don't understand. We try to stick with repeat issuer that we know very well. We speak to companies on a daily basis, and we try to have a high conviction portfolio around 50 to 70 names where we understand the business, and we are very confident that we're going to get repaid. Funny enough, we found a lot of distress opportunity in Europe. Despite the quantitative easing and the bond buying program by the ECB, you have a part of the market that has been completely left out, which is the high yield bond market, and especially some sub-segment of the high yield bond market in Europe. And so we think that on this segment, there's a lot of value to add if you really do the credit work and speak to the company and really understand what's happening on the ground.
Okay, and can you speak a little bit more about that as far as you guys are looking at distressed stuff? When you look at some of these distressed high yield bonds, basically you don't want any bankruptcy risk. Where are you focused when you guys look at the balance sheet of these companies? What is the focus, and how do you come to your determination to pull the trigger on these that are obviously trading at a discount?
So what we're looking at in fixed income, and I mean what we want in fixed income is to have a business that has some assets where we have some ability to enforce our credit rights if something happens, first of all. And what we want also is to understand the management strategy, why the company is distressed, why it's trading at this spread level. And when I say distressed, I'm not looking at bond trading at 20 or 30 cents on the dollar, but more bond trading in the 70s. Like, I think it's a fertile ground to look at bond trading below 80 cents to 70 cents on the dollar, where you had an event on the bond, the market has puked, and then you really want to understand if the market has puked just because of a technical event, or is really something happening at the company level. So we spend a lot of time, a lot of man hour talking to the company, understanding the business, and if we like what we hear from the management, if we like the jurisdiction as well, then we will invest.
And on the multi-asset strategy side, what's an area that you guys are looking at that has sparked your interest?
At the moment, we've scaled back our equity risk because we're going to year-end and we wanted to protect the performance for our clients. But at the moment, we are looking at several thematics. One that we like is the Asian consumer thematics. We're also looking at adding a lot of ESG component to our investment process. And one of the area that we continue to like as well is some opportunity in Asia, especially China, where we think that the market has lagged, and especially on the tech side. What we look for in equity is completely different from what we look for into the fixed income. So in equity, we really position toward business light or asset light businesses, right? So asset light businesses means that we don't want to have too much of industrial assets. We prefer to have high margin, high growth business. And we don't really care if the price to book is very high of those companies, but we want to have a lot of margin, a lot of cash flow generation. Now, on the fixed income side, it's the opposite. We're looking for businesses that have a lot of assets, so industrial businesses, where if something happened on the credit side, we can take possession of the assets and eventually resell the assets.
Sylvain, can you speak to, does the firm have an opinion or a position related to gold as a part of the portfolio? What's your outlook on gold if you have one, and does gold have a place for you guys?
Sure, I mean, it does. On our multi-asset strategy program, the core allocation to gold is 10%. And at the moment, we are neutral. We are 10% long gold. And we've been increasing our position in the first quarter of this year because when we saw that the Fed was going into a full easing mode again, we thought that rates were coming down, and we wanted to be at a full allocation on gold. So at the moment, we have no plan to change that long position in gold. We think gold is a very good diversifier for the rest of the portfolio. And on average, we'll go as low as 5% if we don't like gold in the cost allocation, and maybe 15% if we really, really like it. But the moment we are neutral on gold, we are at 10%.
Okay, and the way you're expressing that, are you guys doing something with physical gold? Are you looking at the equities? Are you just doing a trust, or what are you doing there as far as the
No,
exposure?
we for the core asset allocation, we're only looking at physical gold.
Okay, very well. And
Yeah, we think the mining is something different. It's not as much as a good diversifier for our asset allocation. So we really prefer to look at physical and gold mine. We can do it, but it would fall into the tactical opportunity.
well, I understand you have been working on a uranium outlook that you are going to send out at some point here shortly. Can we go ahead and talk about that? What are you seeing in the uranium market, and what can we expect coming out of your outlook that you're putting together?
Sure. I mean, we've just finished to write the 2020 outlook yesterday, so I think I'll send it to you after the talk today. What we have been looking at in uranium is like last year in 2018, we really saw some pretty powerful catalyst on uranium, where you had major positive events. Starting in January, you had the Energy Fuel and UR Energy, as you can remember, that filed a petition with the U.S. Department of Commerce. Then you had Cameco that took McCarthy River and Key Lake under care and maintenance. And then you had the listing of Yellow Cake in July. Then you had the announcement by Paladin that they were putting their Langer Heinrich mine under care and maintenance as well. Then you had the listing of Kazakhstan, Cameco. And then you had Rio Tinto announcing that they were going to sell their Rosing mine to the Chinese. So last year for us was really a year where we said, look, the market can really move. They are cutting production, primary production. We think secondary supply are shrinking, and we think the utilities could come back to the market for the long-term contract. So we set it up a fund back in October last year to have a exposure to uranium in our asset allocation. And frankly, 2019 has not been the year we were expecting. I mean, the price uranium is down 9% year to date, and it's been a pretty bad year for uranium miners. Even looking at big names like Cameco, down 20%, or even the US miners I just mentioned, they are down 25 to 30%. But what we really think is that to analyze and to understand the uranium market, you need to analyze at least four major components where we see that have an impact on the price trajectory. So I would say primary supply and secondary supply, it's really important, as well as determining the active purchasing potential from the utilities. And from that, we analyze the consumption requirement and inventory variation. So from what we're seeing in the market today, we think the market is already in primary deficit, that secondary supply could shrink a little bit next year, and that active purchasing from utility should restart hopefully in 2020, but at the latest in 2021, and that the price of uranium should converge toward what we think is the marginal cost of production, actually at the moment about $40–45 a pound. So nearly a double from where we are today.
The fund, when you set that up, Sylvain, what you guys end up doing as far as the size of the fund specifically dedicated to uranium? Can you speak to how much you guys have available for uranium?
When we decided to set up the fund, we had a conviction on the macro side, but we knew that we had no capacity to reanalyze the miners. So we teamed up with Alexander Moliner, which is a former CEO of Paladin, and he became a special advisor to the fund. So he's advising us on what to buy, what not to buy, what's the best asset, best management. Now, in terms of the size, I think it's a very good question. The liquidity in the market, except for Cameco, is really, really bad. I mean, those companies trade a few shares a day. It's very hard to trade around those shares without impacting the market. So what we did to be comfortable is that we capped the we capped the fund at 15 million US, which is very small for us. But we think that if we want to do a good job and be able to do some trading, we think the maximum will be 20 million. So we want to be at 50 million to feel comfortable that we can ensure liquidity in our fund if need be.
Yes, it's very complicated to navigate with large sums. You have to certainly be patient with how you go about doing that. Now, can you speak a little bit, Sylvain, to how you guys are positioning? Like, what are you guys looking at as far as the stage of business in the uranium mining sector? Are you looking at the explorers, developers, producers, all of the above? How many positions do you think you guys would be looking to have in the fund in terms of a total count of companies? And then how are you guys allocating that capital? Are we talking 10% position sizes? How's that all kind of line up for you guys on your view of it?
So in our uranium contention is that we might be close to a tipping point for the uranium markets, but we also know that we could be wrong probably by a year or two, given the level of inventory that we have in the market and the secondary supply that is very hard to estimate. So we didn't want to go all in next year, so we built the portfolio around defensive positions, and defensive position means that you need to own producers more than junior miners, and so the majority of the portfolio is positioned toward like big producers like Kazatomprom, for example, and also some closed-end ETF like Yellowcake or UPC in Canada, where we think that the volatility will stay contained because we don't think the price of uranium will drop below 25, but it could stay depressed to this kind of level for another year or two. So we didn't want to go all in. So we have some junior miner in the portfolio because we want to retain some optionality in the portfolio in case we write and the price starts to move quickly. We want to have some stock that can return 5 to 10 times their money very quickly. But at the moment, we are defensively positioned toward producer, and we definitely avoid most of the junior mines, and especially mines that have requirements for capital raise in the next 6 to 12 months. We have about, depending on the time, we have about 10 to 15 positions in the portfolio, but the weight that we have vary greatly from we can have 1% position in a junior mine to a 15% position in a producer.
And can you also speak to your guys' cash? Obviously, you mentioned there that you're not fully allocated, which I think makes a lot of sense. I think that's been a smart move for a lot of folks to not be fully allocated. We've tried to do that as well. At this point in time, Sylvain, where would you guys say you guys stand as far as cash available in the fund? Are you guys sitting at 50% or less than that? Where are you guys at?
The fund is 95% invested, but the total allocation that we could put into the fund, probably 20 to 25 million if the market start to move and the liquidity start to improve. So at the moment we have about 15 million, so we could potentially increase the portfolio size by 30 to 50%. But before that, we need to see the price move a little bit, and to have confidence that secondary supply is shrinking and that inventory level have stabilized.
Okay, and can you speak to the producer side for a moment? Let's just maybe use Cameco and Kazatomprom as the two primaries. What's your guys' view? I know Alex has a interesting view that's not necessarily mainstream. What's your guys' view on your favorite big producer?
One of our biggest call at the beginning of the year was to be out of Cameco and long Kazatomprom. I mean, we really like management of Cameco. They're doing a great job. The problem on the side, they have great assets. The problem is because they've suspended their McArthur mine, they are now in a way they are short uranium, right? They need to buy in the spot market. So if you believe that the spot market can rally to 40, 45 very quickly, then they'll be forced to buy at a very high price. At the same time, they cannot restart right away. McArthur probably take at least a year to restart McArthur. So in that context, we prefer to stick with Cameco, with Kazatomprom, which is the lowest cost producer, and that benefit also with the ongoing devaluation of their currency, the tenge. And in terms of relative value, I think this call had played very well. Kazatomprom is probably flat, so slightly up since IPO last November, and Cameco is down more than 25%.
Right, and I think a 1-year restart of McCarthy Rivers is awful ambitious in my view. I think it'll take longer than that. I think they'd be very lucky if they even got close to a year.
Always take the bear case. So our view for restarting McArthur is more 18 months. But even in the best case where something happened and they are able to restart in a year, they could face a problem in the market because they need to buy a huge amount of pound in the market to deliver next year.
Right, and I can understand why you would take that approach. It makes sense. If you're wrong, it's even better for you anyway. So that's that's a good thing. Well, can you speak to just a little bit more about your guys' strategy? Are you guys looking at the U.S. at all for exposure to uranium? Are you looking in places like Australia? Are you looking in Africa? Can you kind of speak to other places and your guys' other thoughts and feelings about some of these other opportunities besides the big producers?
So we have a big overweight in the US. I think the situation in the US is ripe for a big performance from the US producers like UR Energy and Energy Fuel, and to some extent to Peninsula as well, company that we own in the portfolio. I think those guys are quite right to point out that there's a national security problem in the mining space in uranium in the US, and we think that even if the White House has delayed and extended by about 6 months the decision on the probe 232, I think it's very likely that we'll see some positive announcement in the next few weeks or few months. Because look, at the moment, I think it'll be very easy for the US, for the White House to come up with a solution where you have the US utilities or the Department of Defense to buy probably 4,000 tons a year at about $50 a pound in the US. So I think even if they buy 4,000 tons a year, that translates immediately into 500 million of sales per year. And if you look at the total combined market cap of US producers, and here I'm talking about producer people that produce already. And if you look at Energy Fuel, UR Energy and Peninsula, the market cap is about 300 million. So I think even a small positive announcement in the US can really have a big effect on those guys. They could easily double from here. Yeah, Australia. I mean, we do like Australia. It's a very good jurisdiction, very good assets. So we own a couple of names in Australia, and we like names that are fully permitted and ready to export company, and where the management is good and when there's no capital raise in sight. Africa would be. I mean, the problem with Africa and at the moment is that it's relatively high cost. Some of the names are very far away from a restart. Even if you take Paladin, like which is under care and maintenance in Namibia, we think that they require a price of at least 55 to restart. So because we have not a great conviction that the uranium price will turn right away, and that you'll see a big wave of new long-term contracts, we prefer to underweight those guys. And then some of the producing assets in Africa are not available to invest. Like you look at the Assad mine, for example, that belongs to the Chinese. It's not possible to invest. So yeah, we do look at company in Africa like the GoviX, Bannerman, Paladin, but it's a small position in our portfolio right now.
As we progress here in 2020, Will you guys be looking to participate, or have you participated? What's the entry strategy in particular to some of these new names, or where you guys want to grow your position? Are you guys doing private placements? Are you buying in the open market? Are you kind of doing a mix of everything? How do you guys approach that?
For regulation purposes, we tend not to participate in private placements or pre-IPO. So we tend to only buy in the spot market. I mean, where we can have a proper closing price. It's just in terms of reporting to the clients. I think for us, it's a better way to do things. But at the moment, we are not looking to invest into new names or new position. We are really happy with the portfolio we have, and we think that is very well positioned to start to make some money next year. We also pleased to see that we've even if the fund is down, we've outperformed most of the industry this year because we were very defensive. So we want to keep this defensive portfolio at the moment and not go really all in into new names or non-producers where there's always the risk that they raise capital and then you get diluted and the stock drops by 20 to 50%. I mean, it's what happened to Paladin this year. If you look at Paladin this year, I mean, the stock is down 50%. If you have only a 5% position, you'll be down only 2.5 already on that position. So it's not a risk we are willing to take.
When you meet up and you talk with Alex and you guys have your meetings about the sector, can you speak to how Alex is with regards to his conviction for seeing the uranium price move up to $40 or $50 a pound? Can you speak to the level of excitement and conviction that Alex has for this particular special situation in uranium? The outcome is highly probable in favor of what we've done to position ourselves. Can you kind of speak to what Alex would have to say, or can you maybe speak to your experience in the meetings with him?
Sure. I mean, I speak nearly on a daily basis with Alex, so I start to understand quite well his view. I think it's better if you speak to him directly. But what I can say is that we've helped us to work extensively on our model for uranium demand and consumption. And from our discussion, I mean, he really believes that we should see a normalization of the uranium price at least to the low 40 to 45 in the next 2 years. Also, he has, I mean, he knows inside out the industry, especially at the mine level. So the level of insight he has on management and the quality of assets unbelievable. So I think on that part, he has added a lot of value to the fund. His main contention is that the price should go back to 40, 45, as I said. But when he speaks, I mean, he also mentioned several times that the uranium market is ripe for disruption because we have a primary supply deficit. So if you have a disruption at the mine, if you have a geopolitical disruption, the price could really spike maybe to 50 to 70 dollar a pound very quickly, a bit like we saw in 2010 or 2040, where the price quickly moved between 80% in 2010 to 50% in 2014. And on that, I mean, we are looking at, I mean, I know he's focusing on the what could happen with the Iran waivers and the impact that could have on Kazatomprom and Rosatom. The fact that you have the Russia suspension agreement that expired in December 2020, just after the election. He's also looking at disruption that could happen with the resolution in the US probe. So, I mean, overall, we think that on a normalized basis, the market should go back, the price should go back to the marginal cost of production at $45 a pound, but that the market is also ripe for any disruption on the geopolitical side or on the production side.
What kind of conditions in the market would you need to see to really start to exit the sector?
If we see that our assumptions in terms of supply and consumption are challenged, we could exit the sector and say, look, we got it wrong. We have to change our mind. If we see that maybe the secondary market is not what we expect it to be, if we see that inventory don't move, but frankly, if you exclude a major event like Fukushima, for example, where you had Japan had to switch off 45 reactors in one shot, where you have a major impact on the market. It's hard to see the fundamental situation changing over the next year or two, because the producer, they've announced production cuts. Cameco just said, like in their call in November, that they will keep McArthur Mine under care and maintenance for as long as it takes, and they don't want to restart if you don't get a contracting price of $45. You have Kazatomprom that said again that they are going to produce 20% below their nameplate capacity. So overall, it's hard to see production really moving above 54,000 tons a year. On that side, we are covered. So of course, if we see Cameco Kazatomprom starting to produce much more and reaching nameplate capacity, and the primary supply going from 50 to 54,000 a ton to back to 60, then we will have a problem. But I really don't think we're gonna see that in the next year or two.
I certainly agree. I think we've got some time before those types of events will come to us.
Just one thing, when I speak with Alex, we think that really the key factor, the key element that is unknown and that could postpone the recovery of the market by 2 years or 3 years is really the level of inventory. The level of inventory is very hard to estimate. You can estimate what's available for sale in the spot market, like the WNA report did, but you have also other inventory that could come to the market from Russia, some underfeedings. So it's very hard to see what level are we going to stabilize, and at what point utilities are going to start to recontract. We think that time is soon. If our assumptions are correct, we think by end of next year we should see a big wave of long-term contracts on the utility side.
I agree. I think there'll be quite a bit of action coming up with the utilities. Maybe not so much in 2020, but certainly 2021 onward there. I think we'll have some pretty good action that'll start up. And, I would really be surprised if folks like China and Russia are looking to sell into the market their inventory. That would be very surprising to me. Not too much of a concern, but I would just be very surprised that they would do that at this point and at this price. I don't see how it benefits them to do so. So I think that's also a positive thing. Well, Sylvain, how can folks reach out to you and the company for more information about the fund?
Well, they can reach me by email. They can go on the website. We have a link there where they can contact us, and I'll be happy to answer any question they might have.
Well, Mr. Baude, we really appreciate you taking the time with us.
Thank you very much. It was a pleasure to be on your show.